welcome back. So in this video, we're going to talk about Fibonacci. This is one of, if I'm honest, before we get into the other sections of this advanced section of the course, this is one of the only tools in this chapter that I consistently use, okay? Um, for my trading style, moving averages, which is something we're going to talk about, is not something that I massively use because I think it draws me away from price. But I do know that some people find them very beneficial, and I do have some beneficial ways to use them. So I'm not just including it in here for the sake of including it. I have used it. Time on, time off. I will start using moving averages, just depending on how I'm feeling at the time. But generally, 90% of the time, I'm not using them. But Fibonacci, I do use. So what I'm going to do is talk about Fibonacci in this video, and show you exactly what it is, how you're going to use it, or how you can use it, and how I use it myself. So when it comes down to Fibonacci, what it is essentially retracement levels. And as we know, we spoke about pullbacks. They are retracements where the market, say, makes an impulse move, okay, the main movement, and then it will pull back, retrace a certain amount of that move, and then fall further, as you can see. Fibonacci is a good way to gauge where the market is going to reverse, okay? Fibonacci looks something like this. So what it's going to do is put a line on your chart, which essentially tells you how much of the move has been retraced or pulled back through. So the Fibonacci levels that I use are the 71. This one is not a default Fibonacci level, okay? You're probably going to have to add this yourself. If you use TradingView, by the way, that's the Fibonacci, okay? On this one, you want to find it there. It is Fib retracement, it's called. I don't use Fib extensions. I use Fib retracements. Fib extensions, to be honest, to me, seems like a way just to get yourself a bit more confused than you need to. Right, so Fibonacci retracements. The levels I use, 7-1, 7-8, and 88, right? 886, I mean, 88 is better. I've actually rounded these off recently. They're normally the 78.6. The 88 and the 71 are ones that I've added in myself. These are levels that, from my experience, I've seen reacting very well. So 71, 78, and 88. Now, most of the time, the focus is going to be on 71 and 78, but often on some volatile pairs, maybe like GBP AUD and gold, we will get reactions on the 88% Fibonacci as well, okay? So what I'm going to do for now is remove that one because the most important levels and the ones we're going to discuss in this video mostly is going to be the 71 and the 78. Right, so you can instantly see I've drawn this fib tool on. Now, to draw a fib tool, you want to get it and you want to connect it. Say you are looking for a short trade. So from this movement, we've seen a big downside move. Let me just scale the market back to avoid any confusion. We've seen a big downside move on this market, and we know that we want to sell. All right, we've seen the structure give way. For the sake of it, just focus on the fib for this video. Don't worry too much about all the other confluences. I'm just showing the effectiveness of Fibonacci. So you want to connect it from the high of the move, the swing high, to the swing low. So when a low is in the move, connect the top to the bottom in a downtrend. And if you were looking at it from an upside perspective, so for an uptrend move, for example, this movement, from this swing point to this swing point, say, you can connect from the low to the high, okay? And you're essentially looking for two swing points in the market. So as you can see, one swing point, two swing point. Basically, one leg of movement, you want to connect those 2 points, all right? So we've connected the top to the bottom here. Plot them on as precise as you can. And as you see, we've got the 71 and 78% Fibonacci levels now plotted on the chart. So what we'd be looking for is a reaction in that zone to actually sell from. Now, what I don't want you to do is get caught up focusing just on Fibonacci and actually start ignoring price. You need to make sure you're focusing on price first. But if you see good reactions, if you see good zones in price and they begin to react with the Fibonacci as well, that can be used as an additional confluence as well. So what I want to emphasize is in this chapter, Advancing Your Trading, when we talk about Fibonacci and moving averages, they are additional confluences. They are to add confidence. They are not to lead your trading, all right? As you've seen from the other videos, we do not need this to trade successfully. This is just a beneficial addition to our trading toolbox. So, looking at the 71 and 78, we can see that these take us up just into this little pocket. Now, what is interesting to see is we have, of course, correlating with these as well. Just above them, we got the 750 key level. And what we actually have is the 750 key level reacting as resistance in this range here. And then the range was taken out, but pushed back down. So this region does have validity. We know that, okay, if the market reacts in here, we are reacting in a resistance point, we are under a key level, right? So there is reason to look at this area for shorts. So that is, of course, the point where I'm saying use them as an additional confluence, not as the leading confluence. But we've seen the shift in structure. We know we want to sell this market. Now we can use these Fibonacci tools for some more confidence. And generally, we would then want to wait until these Fibonacci levels are retested to actually go and put in our sell order. Now, what these fib levels are useful for is if you want to use sell limits or buy limits in your trading. So automatic orders that sell when price reaches a certain level, or automatic orders that buy when price reaches a certain level. You want to use those on these Fibonacci levels, or you can just use them as an additional confluence for reversals. This is when they become most useful, all right? Either using them for sell limits, buy limits, as a precise level, because if you don't have these fibs, let's say you know you want to sell from this point, it can be a little bit more difficult to find a good level to sell from, to place your sell limit order. If you've got the fibs, you can know, all right, the 71, the 78, these are high probability zones for reversal. So I'm going to actually put my sell limit on the 78 level, stop loss over the high, around 30 or so pips, and then actually I'll target the low again. So something like that, all right? And then if it's tapped, which it often is, it's going to give you a good entry, all right? As you can see, nice and precise, and then the market begins to move down. So Fibonacci can be really useful for finding a home, so to speak, for your sell or buy limit. They can also be really useful for identifying reversal areas. So as you saw, using the 71 and 78, we could have sold from this point and we would have came straight down from there. All right, so you can see that they're very useful levels. Now, notice how the 71 reacted as the resistance for the bodies, but the wicks did make it through to the 78. All right, that's why I probably would suggest normally, if you're using it for sell limits, focus towards the 78, unless it's, of course, the 71 that is correlating with a demand zone, a supply zone, or anything like that. So you can see that that was a really precise reaction, but it's not just a one-off. If we see again the next leg of movement, if we connect that high to that low there, you saw it reacted again on the 71 this time, okay? And chances are it may come back in. If it forms a new low, is it going to form a new low? So there you go, another reaction again already. Let's just allow the market to move a little bit. And then there we go again, all right? So keeping that swing high to the new swing low connected, you can see we react into that zone once, twice, right? So it's not a one-off thing. Fibonacci does react very well quite often now. Let's see how it reacts on this movement down as well. Just wait for the swing low to form. Now that's an important thing when you're using the fib. You need to make sure you find a low in the trend, all right? So you can't connect it to, say, this level to this level. You can't really do that because that's not the low. You need to make sure it's connected to the absolute low of the movement for proper accuracy. So I would say if this is the low of the move, this could be a good place to sell at a glance because we do have this buy to sell kind of supply zone area. And this lines up nicely with it just in this little pocket. So we could very well actually look at that potentially as a sell point. Now, obviously, as we see, it pushes lower. That is why you have to make sure you're on the swing low. Now, this looks like it's definitely going to be the swing low because we have shifted the structure. So let's actually see then how the market reacts if it hits that point. Now, honestly, I've got no idea whether it's going to hold or go through, but it'll be good to see either way. All right, it looks like it may actually go through. Yep, so we've gone through this one. All right, so that is another reason, another thing to talk about anyways. They're not always going to work, okay? These are essentially lines that you've drawn on the chart. A little bit of not guesswork, so to speak, but they are not 100% accurate, all right? What you can actually do then, though, is potentially look at it the other way, right? We've seen shift in structure, okay? So maybe now we should be looking for the downside fib. So we'll wait for the swing high to form, okay? We can pretty clearly say the swing high has formed now. If we connect it from the low to the high, see how well the 71 and 78 react with this demand zone here? Now that is the key kind of 71, 78 fib use that you want to actually use. You want to make sure that it's correlating with other valid and very real areas in the market. You don't just want to be using the zones on their own, the fib on their own. If it correlates really well with a zone like this, then it's going to have more strength, more confluence for you. So I'm just going to let the market run. I anticipate it's probably going to run into here and make a reaction because of how strong this zone is. So let's actually see what the market is going to do for us. I'm just going to speed it up a little bit. It's going quite slow. Coming into that zone now. And yeah, there we go. So that is the Fibonacci's used again, the 71, 78. Making sure we've got the swing high connected. Okay, so there you go. That's pretty much the use of Fibonacci that we want to use. And that really is a key example of Fib. You can see that the 71 and 78 Fib levels surround a demand zone very well after a structure shift to the upside from these lower highs to the higher high. All right. So that is pretty much a golden usage of Fib. Now, how high is this level going to go? I do not know. But this is already, using these levels, possible, 3.5%. 2.8%, whatever. Around 3% could have been secured there because obviously you want to use your buy limit or buy on confirmation from the Fib level, stop under the low of the demand zone and under the 78 as well. And bam, happy days. You could have made a nice few percent on a movement up there. So there we go. That is Fibonacci. Nice and simple. Don't need to talk about it too much. Basically, key uses of Fibonacci is going to be to add confidence to a demand zone or a supply zone, or help you to identify the perfect level for your sell limit or buy limit if you are a more higher risk trader who uses these trigger orders rather than waiting for confirmation. So Fibonacci definitely has a place in your trading. Try it out for yourself. Remember to always connect the very swing high to the very swing low. Make sure that they're not off. Make sure you're also using the wicks and not the candle bodies. And then give it a go. See how it works for you. Don't give up on it too fast, but give it a little bit of work. And if it works for you, then it works for you. If it doesn't work for you, we don't need it, as we've proven in the other sections of the course. All right. I don't always use these. It's worth noting that. I use them more than other trading tools. Generally, the only kind of indicator, so to speak, that I ever will use is a Fibonacci. Stick a moving average on every now and then. To be honest, I don't really need them. They don't provide too much value for me, but as mentioned, I know that they do provide value to others. So we will talk about them. We will talk about my use of them in the next video and what I've actually learned to be effective uses of the moving averages. So thanks for watching. I'll see you over in the next video when we talk about moving averages. I do hope that you're all getting on really well now. Hopefully you understood and enjoyed the liquidity video. And hopefully now this is just building your edge in the markets, showing you these new tools as well.